My name is Randy Beeman, as Glenn just said, and I am one of the directors of Wealth Advisory Services at Glass Jacobson Wealth Advisors. Normally, we try to keep our podcast to about 15 minutes or so, but today's show is going to be a little bit longer because we want to bring you some added value. And I am going to be joined on the broadcast today by two other members of the Glass Jacobson team, Zubair Khan and Joe McCarthy. You see their shining faces right there. I'll be talking about some of the investment and economic factors that could determine the near-term future and direction of the equity markets. And then Zubair is going to come on and he's going to talk about how to prepare for the potential sunsetting of the lifetime estate and gift tax exemption. And Joe is then going to join us and he's going to talk about the Secure 2.0 Act and how it could change how you save for retirement. Then I'll be back to wrap up and close the day. Altogether, we'll probably be with you for about 40 minutes, 45 minutes or so, depending on how long-winded I get. So let's jump right in. For those of you that have followed any baseball, you'll recognize this caricature of the famous Yogi Berra. I love all the great quotes that came from Yogi, and this is one is especially is applicable to all the gurus who profess to know what's going on or what's going to happen in the investment markets or the economy in the future. It's tough making predictions, especially about the future. I think about the only thing you can count on for sure when you hear somebody making predictions about the future of the economy or the investment markets especially, is either they don't know what's going to happen or they don't know what's going to happen. I'm not going to be making any predictions here today, but I do think that it does make sense to look at current trends and history and try to project what might happen as a result of those trends or a change in the trends. So that's what we're going to do today. Here's another one of the people that I have enjoyed reading over my many years in the market. Bob Farrell, as it says, was chief market analyst at Merrill Lynch from 67 to 92. And then he published a number of reports all the way up till September of I think he actually went after September of 1998. But if you do any kind of investing, you should look up and read Bob Farrell's list of 10 market rules to remember. And even if you're not doing investing on your own, they're a great general set of rules that apply to many of life's situations. Rule number 9 here is especially applicable to today's discussion. It says when all the experts and forecasts agree, something else is going to happen. That's most likely very true in many aspects of life, not just in investing. So here are the topics that I'm going to try to cover with you today in the next, say, 20 minutes or so. Nobody knows in the near term where the investments markets are headed, as I mentioned. But looking at the longer term, it's clear that if you spread the market out over, say, 75 years, the equity market bias is distinctly to the upside. Even in the most basic terms, that kind of makes sense because if corporate earnings are growing on a long-term basis and there's some level of inflation, you would expect equity prices to just gradually move higher in reaction to those two changes. So it does make sense, just even at a common sense level, without getting into the economics of it, that the upward bias of the stock market on a long-term basis is higher. But there are also times when the equity market, the long-term trend and the upward bias is broken by various elements. Some of those things might be internal changes to the market itself, like excessive valuation or some other thing, or they might be some kind of external shock or a surprise, commonly termed a black swan. Today, we're going to talk about some of the potential risks to the current market advance: accelerating and problematic inflation, a hostile Fed, potential for an oncoming recession, potential for investor exuberance. And here's another quote from Sir John Templeton, one of the greatest investors who ever walked the earth. Remember, bull markets are born in pessimism, grow in skepticism, and mature on optimism, and die on euphoria. we have optimism and some signs of euphoria in the market, especially within the last 6 or 7 months. Speculative valuation is another risk to the market. And finally, a significant geopolitical event. Nobody can predict that, of course, but there are some distinct things that could cause some worry. So let's talk about each of those points. First up is inflation. Here you see the U.S. annual inflation rates from 2014 to 2024. You can see that for most of that period of time, inflation remained at 3% or less. If you see this area of the chart here, it's been around 3% or less for most of the last decade. In an ideal world, the stock market likes to see sustained growth in prices of around 1% to 3% a year. That's considered low to moderate inflation. And it's considered a healthy environment, which means that the value of the dollar remains more stable, the demand for goods and services holds pretty steady, and prices are fairly predictable. That's the best case scenario. But as a byproduct of the sharply increased demand following the reopening from the pandemic and the restart of global trade, inflation skyrocketed all the way up to peak at around 9% in 2022. Now, it's since declined, but over the last year has basically been moving sideways. And the most recent report that just actually came out today for May showed that inflation is annualizing at a 3.3% if you look at all of the different components. So we're still a little uncomfortably above that 1 to 3% range. And we're also above the Fed's target rate, which we'll talk about in a little bit. So a persistently high level of inflation, if it doesn't decline into that target rate, will be a risk to the market eventually. Consumers are clearly feeling the levels of inflation rising. Here's this shocked me actually when I saw this chart. The McDonald's price increases in different categories. My favorite is the McNuggets, by the way, 69% inflation. There's a recent poll by CBS that indicated that 75% of American consumers say their incomes are not keeping pace with the current price increases. That's a problem. Not only for the average consumer, it's consistently a problem for the Federal Reserve as well, because one of their mandates is price stability. Here we're seeing a chart that comes directly from the St. Louis Federal Reserve website, the FRED, by the way, it's called. If you do any kind of research, this is a great site. And elevated levels of inflation are not only important to consumers, they're something that's watched very closely by the Federal Reserve. So here what we're seeing is what's called the five-year forward inflation expectation rate. Basically, in semi-English, it's an estimate of inflation expectations for the 5 years that begin 5 years from now. Inflation expectations are essentially the rate at which people, consumers like you and me, businesses, investors as well, expect prices to rise to in the future. They matter because actual inflation depends in large part on what we expect it to be. For example, if everybody thinks prices are going to rise by, let's say, 3%, they think they're going to rise over the next year by 3%, businesses are going to want to raise prices by at least 3%. And workers and their unions are probably going to want similar kinds of raises. So it becomes a self-fulfilling prophecy. The Fed's mandate is to achieve maximum sustainable employment and price stability. They define price stability as an annual inflation rate of 2% on average. And to help achieve that goal, it works to try to anchor inflation expectations at roughly 2%. Well, here we see the current five-year forward expectations are around 2.36%. So close, and it has certainly come down from here. Here's this peak up here, but it's still above where they expect inflation to be anchored at 2%. So if it were to tick back up, then the Fed may need to actually step in and alter interest rates. And here we can see the pattern of how the Fed has changed interest rates over time. This chart goes back a decade, and we can see that they've managed the level of interest rates significantly over that decade. Now, they kept interest rates flat, basically at zero coming out of the housing crisis. Then they started to slowly move them up as they tried to normalize rates starting in 2016. Then the pandemic hit and they dropped them like a stone back to zero and kept them at zero until early 2022 when they started a stair-step path of very quick acceleration of interest rate increases to try to combat rising levels of inflation, as we talked about coming out of the pandemic when the world restarted again. So currently, the Fed funds target rate is set at 5.25% to 5.5%, and the effective Fed funds rate right now is 5.33%. The Fed actually is meeting today, and they'll decide at 2 o'clock. They'll announce their current rate decision. Nobody expects them to move interest rates, but getting a little bit of wonky on you, but they're going to produce something called the dot plot with the end of today's meeting, which is the projections of the members of the Federal Reserve where they see interest rates over the next year. That might possibly move the market if it's a surprise, but we'll know later this afternoon. But currently, the Fed's target rate is between 5.25% and 5.5%, and the Fed funds rate is staying right in that target. Now, that's important for a number of things. It has to do with the level of stocks and valuation because the interest rates are considered the risk-free rate of return, but it's also important for bonds and treasuries in particular. And higher rates also impact us in the real world because it affects things like credit card rates and mortgage rates and all kinds of different follow-throughs. But one of the most direct impacts of the level and direction of rates is to the U.S. Treasury market. And first of all, with rates higher today, investors, especially conservative investors, for the first time in over a decade, have a chance to actually lock in real yields from treasuries. That's a big deal because it means there are alternatives to just investing in things like dividend yielding stocks for income. So it siphons some money off of the equity markets. Here we can see that there is a strong correlation between the yield on the 10-year Treasury note and the Fed funds rate, an actual 90% correlation between the note on the 10-year Treasury and the Fed funds rate. And then other things are also impacted: inflation, wages, headline inflation, unemployment rate, and so on. And the reason that correlation is important as investors, and because you have the opportunity to add yield to your portfolio now in real income assets, is if we think the Fed might actually change interest rates in the future, that correlation is important because the Fed has openly stated it would like to begin moving the target interest rate lower as soon as it becomes comfortable that inflation levels are retreating. So the Fed's caught in a little bit of a quandary. They want to lower interest rates, but they really can't do it until there's more progress on the rate of inflation because of their dual mandate. But eventually, you would expect inflation to come down from its current levels, and they will get comfortable and be able to start lowering interest rates. So here in this chart, we can see that if rates drop by 100 basis points, which is 1%, from the target rate, 5.5% to 4.5%, the total return potential on different maturities of treasuries, starting at 2 years and going all the way out to 30 years. The blue color here is actually the return from the coupon or the yield in the treasury, and the red would be capital appreciation of the treasury. And the way to think about this, the easiest way to think about the potential for capital appreciation in treasuries or any kind of bond, is because the longer dated maturities have the most leverage. Think of it like a seesaw. When one side goes down, the other side goes up. So to get capital appreciation in a bond, you'd have to see interest rates declining. So if the Fed is potentially going to lower interest rates over the next 12, let's say 18 months, the impact on the various maturities of treasuries could produce a reasonably pretty strong total return if that's the case. Now, I mentioned that the Fed had enacted a pretty aggressive rate hike policy coming out of the pandemic, as we saw in the previous chart. Here you can see that this is actually the most aggressive rate hike cycle in the last 40 years. 2015, 2004, 98, 94. None of them, they hiked rates as fast as they have in this cycle. And there are implications for that. Here we can see, going back again 40 years, or actually, yeah, about 40 years, I guess. There are a number of impacts from rising rates on the economy and the investment markets. A lot of them are beyond today's discussion, but one important one is the odds of a recession. And so we can see in this chart, over the last 40 years, every single time the Fed has raised rates to a near-term peak in interest rates, it's been followed by a recession in the economy, which are these gray bars here. Every single time. The saying goes in the investment markets, if the Fed raises rates until something breaks, and then it has to reverse course and it drops rates again to try to stave off or make a recession less severe. Also, interestingly, it's very clear in this chart, you can see that the peaks are lower each and every time until you get to here, indicating that it's taken less increase in interest rates every single time for the economy to fall into recession. I think partly because the economy is more sensitive now to changes in rates because we have such high debt levels. And at the very far end here, you can see this is the near term, at least right now, unless they reverse course and raise rates more, the near term peak in this interest rate rising policy period. Now, only time is going to tell if that's going to ignite a recession. But, you know, if you're a betting person, the odds are favorable that it might eventually see that outcome. But the timing of a recession is very problematic. You can see here that since 1967, 26 months is the average length of time from the start of the Fed increasing rates for a recession to actually start. It goes back to 1967, the average is 26. Well, as of this month, we're 27 months since the start of the latest Fed hike campaign. So we're actually at the average. Now, it doesn't mean that it's going to happen. Look, 42 times, 30 months, 32 months. Who knows? I would bet, though, that the odds are in favor that we will eventually see a recession as a byproduct of this most recent Fed rate hike cycle. And there are some indicators that may be coming down the pike. Here we can see credit card debt. Look at the soaring level of credit card debt. Again, since the reopening after the pandemic, this is predictable. We were seeing a steady decline or steady increase in the use of credit cards. Then the pandemic, now we've really soared in credit card debt. And accompanying that, look at the level of delinquency in credit cards. It's reached the previous peak back here in 2011. So there are signs that the economy and the consumer are starting to weaken. There's also anecdotal signs. Walmart reports great earnings and Dollar General reports good earnings because people are downstepping. They're shopping in stores where they can get more bargains. So there's a lot of anecdotal evidence as well. And keep in mind, 66% of the US economy is consumer spending. So when the consumer slows down, it tends to fold through into the rest of the economy. The next to the final risk factor I want to mention to you is the level of exuberance and speculation. Here we see a chart of the S&P 500 PE and forward returns over 1, 3, and 5 years. When you have things like GameStop shares moving up and down by 30 to 50% in a single day, or some of the tech AI related stocks trading at triple-digit PEs, that seems to me to be a pretty good indicator of some pretty good extreme speculation and exuberance. But maybe I'm just old. I don't know. But you do have also in the broad market, as measured by the S&P 500 here, a PE level that right around 22 times. And historically, when it reaches that period, that level, the forward returns 1, 3, and 5 years are not all that stellar. Now, if we were to move this PE number up above 22 times, which we've been on several occasions historically, look at the forward returns. They're not great at all. And it just makes sense. The market gets expensive and it's pricing in expectations for future earnings growth that may not materialize. So the forward returns tend to suffer. So the last risk factor that I want to mention to you before I turned it over to Zubair and Joe is the geopolitical element. And of all of the stuff that we've covered, it's probably the most difficult to get any kind of an idea about the risk level. There's no question in my mind, there's a significant level of geopolitical risk in the world today. Is it more significant than at some random periods in the past? I don't know. I mean, there certainly were significant geopolitical risks in history, but it just seems to me, as a layman, that there's a fair amount of geopolitical risk today. From the ongoing conflicts in Ukraine and Russia, and then you have the Israel-Hamas conflict, to the continuing kind of saber-rattling and threat that China might someday invade Taiwan. And then we have the complete unknown element of the November presidential election that I'm pretty safe to say will probably cause some heightened volatility in the election markets as we get close, especially if we get to the end of the day on the election day and we don't know who the winner is if it's so close. There's an old saying in the investment markets, the markets can handle bad news, they can handle good news. They just don't like uncertainty. So an uncertain outcome in the election would cause some volatility. And according to the polls that I've seen, it indicates that about the only thing the majority of Americans can agree on about the election is that most of them don't really want either candidate. So in short, nobody knows for sure what the future is going to bring. And I'm not going to make any predictions. Nobody can. But it is important that you invest for your long-term benefit for sure. But I think it's also wise to keep an eye on the potential short-term risks to that long-term upward bias so that if you do see some storm clouds on the horizon, you might be able to take some shelter. These are some of the footnotes, some of the sources, if you're interested. They'll be on the posting so you can look at them in more detail. I want to bring in Zubair now, who has 18 years of industry experience. He holds 2 master's degrees, one in business administration and one in accounting. He's also a chartered financial analyst and a certified financial planner. He's going to be talking to you about how to prepare for the potential sunsetting of the lifetime estate and gift tax exemption. Come on in, Zubair. It's all yours.
Hi, Randy. Thanks for having me. Thanks for everybody who's listening in or watching. We appreciate you joining us. So like Randy said, I am going to be talking about something that should be top of mind, and pretty much with any part of estate planning, it can get really complicated. And before we go into anything further, if some of these things apply to you that we talk about, I would recommend speaking to your accountants, your attorneys, and your financial advisors to make sure that you have a great plan in place and that you understand all of the ins and outs of all of these tools. So why are we talking about this today? Just to give you a little bit of background, in 2017, the Congress passed the Tax Cut and Jobs Act, which made a change to the exemption amount, the lifetime exemption amount for estate and gift taxes. So before that, it used to be that an individual would be exempt if they gave anywhere below $5.6 million. And after the Tax Cut and Jobs Act, they increased the exemption to $11.8 million per person, okay? So today, it's actually, the exemption amount is 13.61 million. It kind of goes up every year based on inflation. So that amount kind of went up because of that. And so 13.61 million per individual, and then 27.22 million per for married couples. So the problem is that this exemption is not become a permanent law. So this exemption is actually going to expire at the end of 2025, on December 31, 2025, and the term for it is called sunsetting. So that part of the Tax Cut and Jobs Act is going to sunset at the end of 2025 unless Congress acts to make it permanent or enforces some new laws. Now, if no action is taken by that time, what will happen is that the exemption level will revert back to 5.6 million plus something for inflation. Now, for individuals, most people think it'll range between somewhere between 6 to 7 million per person and 12 to 14 million per for married couples, but we're not sure about that at this stage. So just to give you kind of an idea of who this affects, in 2023, about 7,100 people had to file an estate tax return. Now, just because you file an estate tax return doesn't mean that you actually owe estate taxes. There are certain thresholds that you have to meet in terms of having an estate, and they're usually less than the exemption amount. And so 7,100 people filed estate tax returns, and 4,000 people actually had taxable estates. So if you look at the amount of people who passed away in 2023, the National Center for Health Statistics said that about 3 million people died in the US in 2023. So roughly 0.22% of those who died in 2023 had to file estate tax, and an even smaller amount, 0.12% of those who died in 2023 owed estate taxes. So there are not a lot of people who qualify for these higher thresholds. 4,000 people in 2023, like I said. But if you look before 2017, in 2016, 11,200 people had to file taxes, and then 5,300 actually owed estate taxes. So, there's a significant amount of people that will fall into the original exemption, which, well, very few people technically fall into the higher exemption. But because you're paying like 40 to 45% potentially on the amount that you'll leave behind, it could be a big deal if you are one of those people that fall into that category. So what do we do? How do we get ready for this? Okay, so the first thing you should know is that the IRS said that there's not going to be any clawback. So if you are somebody who takes advantage of the current higher exemption of that 13 million or the 27 million if you're a married couple, and then the amounts drop in 2026, you're not going to be penalized for that. So it's important that you kind of take action now if you are above the old exemption limits. So, one thing you want to do is make sure that if you lock in that expanded exemption amount before 2026, if you are somebody who is going to fall into that threshold, if you're over the old exemption amounts or the potentially lowered exemption amounts that are out there, you want to do it in the next 2 years, or actually by the next year and a half or so. And you want to take advantage of the greater exemption amount. So how does that work? So let's say the exemption amount reverts to $7 million, and you had $2 million total in gift and estates that you wanted to leave behind. You're not going to really be affected, so you're going to be okay. But if you had $9 million, then you would be affected. Okay, so that's if you're somebody in that category, you want to make sure you take advantage of it now, of the higher exemption amounts if you can. And to take advantage of the full amount, you would want to, if you're a single person, then you'd want to put in, do something with about 13.61 million to take advantage of that amount now. And obviously, if you're a married couple, you'd want to do 27 million. So I'm going to start off with some of the simplest strategies first. And obviously, one way to reduce your estate is to give to charity. and you can give as much as you want to charity, and you can get charitable tax deductions for that as well. But if you're not somebody who is charitably inclined, or you have important people in your life that you want to take care of, and that takes precedent over any sort of charitable gifting, this is the simplest way is to take advantage of the annual gift tax exclusion. And like I said earlier, in 2024, the annual exclusion amount is $18,000. So if you give per person, per recipient, so if you give below $18,000, it's not going to eat into your exemption amount, nor are you going to have to pay any gift taxes. Now, it's important that you understand that it's per person, per recipient. And that you and your spouse can each give $18,000 in 2024. So that's $36,000 that you and your wife can give together to the same recipient. Okay. Now that doesn't mean that that's the total amount you can give to anybody. You can actually, each of you can give $36,000 to different recipients. So you are able to give away much more than that, but per recipient, you're combined, you can give $36,000. Now, when you and your wife, your spouse, I should say, give money to a recipient of up to that $36,000, that's called gifts, a split gift. And sometimes you may have to fill out some sort of form saying that that's some sort of IRS form to say that you're doing this gift splitting. So, like I said before, it doesn't count towards your exclusion if you give anywhere below that, and you can obviously keep giving that amount, giving below the annual exclusion amount. The annual exclusion amount, just like the exemption, lifetime exemption, can go up every year based on inflation and other factors. So, it's 2024, it's $18,000, but it could be more in the future. So that's the first way to reduce your estate. By giving below that amount, you're not eating into your exemption, you're reducing your estate, and you're reducing potential for having to pay estate taxes. Another thing that you can do is pay directly to a school or medical provider. Now, you can give any amount you want to schools or healthcare providers, or cover health expenses, because they're not counted as gifts if you pay them directly. So this is basically a direct transfer where you pay the tuition of maybe one of your children, and you pay directly to the school. If you do that, it's not a gift. It's not considered a gift at all. And then for medical expenses as well. So if you pay directly, it's not considered a gift, and it doesn't even count towards your annual exclusion amount. I want to thank you all for having me, and I will hand it back over to Randy. Randy, thank you.
Thank you, Zubair. It's a very, very complicated subject, and I'm sure if listeners or viewers have more questions, they can always reach out to you and get more specific types of information. Let me go now to Joe. Let's bring in Joe. He's been in the industry for about a decade, has a bachelor's in finance, also holds a chartered financial consultant and certified financial planner designation. And he's going to talk to you about the Secure 2.0 Act and how it could change how you are saving potentially for retirement. Joe, the screen is all yours.
Thank you, Randy. I'm just sharing my screen right now. I know we're running a little long, so I'll try and be brief. The Secure 2.0 Act, in the world of DC politics, it can sometimes seem like there really aren't many topics that both sides of the aisle can agree on. Bills that reach the House floor are commonly decided by just a few votes, one way or the other. However, in 2022, there was a piece of legislation passed that bucked that trend. It was the Secure 2.0 Act. In December 23rd, 2022, the House of Representatives passed the Secure 2.0 Act with a bipartisan vote of 414 to 5. The bill was shortly signed into law by President Biden December 29th, and the changes took effect shortly thereafter. It's actually an expansion of the Setting Every Community Up for Retirement Act passed in 2019, and which was the original Secure Act. Some of the provisions took effect in 2023. However, a majority actually took effect beginning this year. One of the main reasons for the expansion on the original act was that in 2022, the Survey of Consumer Finances found that almost half of all American households had no retirement savings whatsoever. This act actually adds dozens of provisions over a number of years to help Americans prepare and save for retirement through employer-provided plans and the use of IRAs. Many of these provisions are not just aimed at individuals at the extremes of the income scale, but rather aimed at the average American. So I just want to go through a few of the highlights and changes that could potentially affect some of you. RMD changes. People are obviously living longer. The government realized they may be forcing people to take too much money out of retirement too quickly. In light of this, they decided to increase the RMD start age from 72 to 73, and it's actually going up to 75 by 2033. So this will affect individuals born in 1960 and later. They won't have to start their RMD until the age of 75. You can see the little chart in the top right there. Penalties. There was previously a 50% penalty of your RMD if you didn't take it by the required date. This could potentially be huge. If there's any professionals on the call, I know some of you may have clients that have very large IRAs, and very large IRAs have very large RMDs. Paying 50% of that to the government in a penalty would not sit too well. So they actually reduced the penalty, cut it in half down to 25% beginning this year, and it's decreased down to 10% even further if you if the missed RMD is corrected within 2 years. Roth 401ks were surprisingly previously required to take RMDs. That didn't make much sense, as Roth IRAs were not required to do so, and the individual could theoretically roll their Roth 401k into a Roth IRA. So it was an avoidable RMD. However, now they fixed that almost error, and so now individuals can leave their funds in their Roth 401k without being forced to take the RMD. Inherited IRAs, this is a big change. The beneficiary or the owner of the IRA could previously use what was referred to as the stretch RMD or stretch IRA tactic. The beneficiary could stretch their RMDs over their lifetime using the life expectancy table. Well, the government realized that they were waiting to have to wait sometimes decades to receive the income tax on those withdrawals from these accounts because they could stretch it out. Sometimes individuals were inheriting these in their early 20s and stretching it out to the 80s, their 80s and 90s. So they replaced that with what's called the 10-year rule. It comes down to that the account must be completely zeroed out by the end of 10 years, starting the year after the original account owner passed away. This is also in addition to still taking those annual RMDs, so you do have to abide by both. Spouses are still able to roll their deceased IRAs, their deceased spouse's IRA into their own personal IRA, tax-free, and there are a few non-spouse beneficiaries that are outliers from the 10-year rule. If you're chronically ill or deemed fully disabled, non-spouse beneficiaries not more than 10 years younger than the original account owner. This typically occurs in siblings. If you leave it to your surviving sibling, and a minor child of the account owner, but only until that child reaches 21. Once they do reach 21, then they have to abide by the 10-year rule. 401k updates. To motivate, or some may say force, individuals to save more for retirement, most 401ks and 403b plans are now required to auto-enroll eligible employees. Participants do still have the option to opt out. However, they will have to manually do so before the contributions begin. You are now eligible to make up to $1,000 withdrawal from your retirement account once per year without incurring the 10% penalty if you're below the beginning age. There is one caveat though: you cannot make an additional withdrawal for the following 3 calendar years unless you repay the original withdrawal amount, which if you need to take an additional withdrawal, you most likely can't afford to repay the original one. That's neither here here nor there, but you'd have to wait 3 years at that point. Catch-up contributions, beginning in 2024, the standard contribution for employer retirement accounts was increased to $23,000, with a catch-up contribution of $7,500 for individuals age 50 and older. And beginning in 2025, there will be what they call a special catch-up contribution that increases the catch-up amount for individuals 60 to 63 from $7,500 to $10,000. I'm not exactly sure why it was only those 4 years. I tried to do quite a bit of research, and nobody really has a reasoning. But for those 4 years, you are able to contribute an additional $2,500. Beginning in 2026, though, the catch-up contributions made by individuals that earned more than $145,000 that year must be made on a Roth basis. So this unfortunately eliminates the upfront tax deductions for those catch-up contributions, but obviously you get the Roth benefit of the tax-free withdrawals. And a bit of a hot button issue, the student loans. If an individual does not have the funds to contribute to their retirement, but would still like to enjoy an employer match, now the employer can base that match off of their current student loan payment amount. This could potentially be a good option for younger employees who are fresh out of school, who are at a lower income level and still making student loan payments. And unfortunately, they can't afford to contribute to their retirement plan yet. It'll be a way for them to participate in the plan and begin saving earlier. However, this is at the employer's discretion, so we will see how many plans actually opt in for this. 529 Roth rollover. This is one I've actually run into a few times this year already. Starting this year, custodians of a 529 plan are now able to roll over $35,000 lifetime from a 529 into a Roth IRA. Granted, the owner of the Roth IRA is the same as the beneficiary of the 529 plan. You can do this for each 529 plan if you have multiple for multiple children, nieces, nephews. So you can do it for each one of them. There are a few rules, though. As I mentioned, the beneficiary of the 529 must be the same as the owner of the Roth. The 529 must be open for at least 15 years, and you can only roll over annually the contribution limit, the Roth IRA contribution limit, which is currently at $7,000. This will also count as their IRA or Roth contribution, so they can't do this rollover and contribute. This would count as that. This could be a good option for a family where the beneficiary of a 529 has finished school, they have no plans of further education, and there's still a considerable amount of funds in the 529. They can still change the beneficiary to another child, grandchild, niece, nephew, but before they do, it'll be nice to roll a portion into a Roth IRA for the original beneficiary and get them saving for retirement early. Qualified charitable distributions. If you make a donation to a charitable organization from your retirement account, the amount distributed is obviously not calculated in your personal income. Typically, individuals will do this with their RMDs if they don't need the money and they're charitably inclined, as this will remove that RMD from their income calculation. Previously, you were only able to make the donation to a DAF, a donor advised fund, or directly to the charitable organization. However, you are now able to put those funds into either a charitable gift annuity or charitable remainder trust with limitations. Since one of the limitations is only a $50,000 lifetime amount per individual, I'll focus on the charitable gift annuity, as the charitable remainder trusts typically have much higher maintenance and admin costs, and it really just doesn't make sense to use them for only a $50,000 or $100,000 donation, depending on if the spouses combine theirs. The charitable gift annuity is nice because it's set up so that the individual will donate up to the $50,000 individual limit to the CGA, and they will receive an upfront partial tax deduction on that contribution. The donor is then required to take out a certain amount of income each year from the CGA. It's typically set at least 5%, and at the end of the donor's life, whatever is remaining in that annuity will go directly to the charity. And the last major change is the Savers Credit Contribution. Currently, there's a tax credit for individuals that contribute to a retirement account and fall under certain AGI limits. It was called the Savers Credit, beginning in 2027. So this is the furthest out change. This is being replaced by the Savers Credit Contribution. In short, instead of receiving a tax credit matching what you contributed to a retirement account, the federal government will now essentially offer you an employer match of up to $2,000 into a retirement account for individuals under the AGI limits listed on the page. Again, this is a great way for young professionals to boost their retirement savings, get more retirement early, because we love the term compound interest, making the interest on your money grow. So those are the brief updates, and I will pass it back to Randy Beeman, who should be able to finish us out today.
Thanks, Joe. I appreciate it. And I want to thank everybody for joining us today. Let me put the logo back up here so you can see the podcast logo, because I want to take a second and plug our podcast. It's called Common Sense About Your Money. We produce it about once a month, and it's posted to our social media sites as well as our website at glassjacobson.com. So check it out. There are some previous podcasts there, and you can also read some of our blog entries if you have a moment. And as always, some of the topics that we talked about today, especially the stuff that Zubair and Joe covered, are really complicated. And if you have further questions, you can always reach out to one of them and they'll be happy to answer your question directly. We do appreciate you tuning in, and we hope you've enjoyed it. And we hope you'll check us out in the future.